On February 18, 2026, a major Wall Street firm called Blue Owl Capital locked the exits. Investors in one of its funds could no longer withdraw money. This change was not temporary. The quarterly redemption window was shut for good. Blue Owl manages over $300 billion, and this freeze sent shockwaves through every trading floor. Apollo shares dropped 12% in days. Blackstone fell by the same amount. KKR plunged 16%. Why did one fund's decision rattle the entire financial system? Because it exposed a crack in something enormous. Private credit is a $3.4 trillion market. It now rivals the entire high-yield bond market. Yet most people have never heard of it. These are investment funds that lend directly to companies banks won't touch. They charge higher interest rates and promise juicy returns. For years, everyone seemed to win. But cracks are forming beneath the surface. And the money flowing in now includes something new. Your retirement savings might be next in line. The financial system nearly collapsed in 2008. Lawmakers responded with sweeping new regulations. The Dodd-Frank Act and Basel III forced banks to stop making risky loans. Higher capital requirements made dangerous lending expensive. America's largest banks shed risky assets and became demonstrably safer. But the companies needing risky loans didn't disappear. Into this gap stepped a new breed of lender. Private credit funds raised money from pension funds and wealthy investors. They lent it directly to companies banks wouldn't touch anymore. Returns ran 8 to 12% annually. What happened next was absolutely staggering. The market was $44 billion in 2000. Today it approaches $3.4 trillion. 5 firms now dominate this world. Apollo, Blackstone, Ares, KKR, and Blue Owl manage trillions combined. Regulators had pushed risk out of the banking system. But the risk didn't vanish. It just moved next door. And then something ironic happened. Banks lent $300 billion back to these funds. JP Morgan's exposure to non-bank lenders tripled. It now sits at $160 billion. The risk took a detour and came back through the side door. Here is where things get truly uncomfortable. When you buy a stock, millions of trades set its price daily. Private credit loans have no public market whatsoever. So who decides what they're worth? The same people who made the loans. Fund managers set the value of their own assets quarterly. Since fees depend on those valuations, higher marks mean bigger paychecks. That is a textbook conflict of interest. BlackRock once valued a loan at full price. Weeks later, the borrower declared bankruptcy with almost nothing. The loan went from perfect to worthless overnight. Bond investor Jeffrey Gundlach nailed the absurdity. He said private credit has only 2 prices: 100 or 0. There's also a trick called PIK, or payment in kind. Instead of paying interest in cash, borrowers pay with more debt. A loan keeps growing while the borrower looks current on paper. The official default rate hovers around 2.5%. Count these hidden signals, and the real number approaches 6. Then came the fraud cases that shattered confidence entirely. Tricolor Holdings was a Dallas car dealership chain. It collapsed in September 2025. Prosecutors revealed fabricated loans and double-pledged collateral. The fraud topped $800 million. 18 days later, auto parts giant First Brands filed for bankruptcy. Investigators uncovered $2.3 billion in fake receivables. JP Morgan CEO Jamie Dimon delivered the line heard everywhere. He warned that when you see one cockroach, there are probably more. Gundlach went further, calling private credit lending garbage. He predicted the next financial crisis would start right here. Here is why this story matters to you personally. Not just to hedge fund managers or pension fund directors. An executive order arrived in August 2025. It opened for 401k plans to alternative investments. That includes private credit funds. Over 90 million Americans hold these plans. Their savings could now flow into this opaque market. State Street launched a retirement strategy featuring Apollo Private Credit. Empower, covering 90,000 employers, began offering private market options. Retail money could reach $2.4 trillion by 2030. But critics were horrified by the timing. Senator Elizabeth Warren warned it could become a massive wreck. Researchers at Boston College asked a pointed question: why bother when these investments often underperform public markets? The fees alone run 20 times higher than mutual funds. Retail money is arriving just as stress builds across the market. Blue Owl's freeze happened in a fund marketed to individual investors. Those people learned firsthand what illiquidity actually means. You can't sell when you want to leave. Your money stays trapped until the fund decides otherwise. So which is it, innovation or time bomb? The bull case deserves fair treatment. Private credit fills a genuine gap in the economy. Half of large American companies are private today. Someone has to lend to them. These funds use locked-up capital with long-time horizons. Unlike banks, investors can't pull money overnight. Blackstone points to tiny loss rates over 2 decades. The 2025 Fed stress test found no systemic threat. However, the bear case keeps getting louder every month. This market has never faced a real recession. It grew entirely during an era of cheap money. Valuations are set by the people who profit from them. Fraud cases keep multiplying across different sectors. And the banking system is entangled again through hundreds of billions. Federal Reserve Governor Lisa Cook offered an unsettling observation. Few private credit providers have experienced a complete credit cycle. Nobody knows how they will perform in a real downturn. That uncertainty, multiplied across trillions of dollars, is the entire story. The experts can't agree on the risks hiding here. Regulators can't agree either. Even the lenders themselves seem deeply divided. So should your retirement savings be anywhere near this market? For more economics, business, and finance, minus the boring parts, check out our other videos.